Hello and welcome. My name is Dervedia Thomas, Associate Editor of FundFire at the Financial Times. I'm delighted to welcome you to our Leaders Panel, where we'll explore some of the themes shaping the industry, including disintermediation, fee pressure, social media, automation, and of course, COVID-19. Please submit questions in the chat box to the right of your screen throughout the session, and you can post on social media using hashtag CrossborderLU or hashtag Crossborder2021. My esteemed panel includes Ilva Beckstrom, a finance lecturer at King's College in London, David Blumer, chairman of Fundinfo, Michael O'Brien, non-executive director at Carne Group, and Bill Street, Group CIO of Quintet Private Bank. Michael, start with you, the disintermediation investment industry. How do you see the space evolving in the next few years?
Well, I'd start by saying it's not going to sort of evolve. I think it's going to continue what it's been doing for the last decade, which I think distributors will continually dominate the asset management industry. I think if we look in the consolidation with the RIAs in the US, the large platforms that are developing in Europe and Asia, I think ultimately the distributors will become the point of focus for asset managers in the industry for the next decade. I will also say that in the institutional space, a lot of the asset managers are now focusing on directly building relationships with the big institutions like the sovereign wealth funds, the big pension funds, and disintermediating the consultants who themselves are building their own asset management capabilities. So there's kind of a shift in the sequencing of those relationships that's going on. I would also add that I do think that a lot of the asset managers, the bigger ones, are starting to build their own direct-to-consumer capability, and we've seen a number of the M&A activity in the US in the past few years, where asset managers are building capability to directly access consumers, and with things like Aperio and Eaton Vance acquisitions, are really more around acquiring technology to access consumer rather than necessarily building asset under management. So I think it's more of a continuation of what's been going on for the last 5 years, but I do think the distributors generally will increasingly be in the driving seat.
Bill, how do you see this disintermediation affecting asset managers? They have to operate.
Yeah, I think that's absolutely right. Mike makes a very good point. I mean, I think when we look at the relationships between the asset management and the consultants have been spending probably the best part of a decade trying to move into asset management and into the fiduciary space. And I think the big institutions are happy to have those direct relationships with the big institutional asset managers. And I think it's right as well in terms of the big institutional asset managers have got a decision to make and where they are in the supply chain. And the further they are away from the market in terms of the retail market and the distribution market, the further they are down the supply chain and therefore pricing power, if you like. So I think over the last few years, they've been happy to take that back seat of being the engineer or the manufacturing of that chain. But I think as they see significant price pressures, and we'll probably get onto price pressures in a minute, they'll see that actually the value and the stability of price is actually closer to the distribution and the retail.
Great. And as we talk about fee pressure, David, how should asset managers adapt, to this sort of fee pressure in order to?
Yeah, I think there are multiple ways of looking at the fee pressure angle when you're an asset manager. Of course, I mean, one is you have to really be very clear where you want to play. I mean, some asset managers are tilting now towards alternative investments to ease some of that fee pressure on the active side or through the passive channel. So that's one aspect. I think another aspect that should not be forgotten which will continue to play a very important role when we talk about fees, when we talk about the growth in asset management. Is truly is client service and really meeting the client expectations on various levels. So, of course, this is just probably a second order effect talking about fee pressure, but I still believe that having an excellent customer relationship, customer service is just one thing which is very, very important these days, because repricing, of most institutional mandates, but also on the wholesale side, are just happening on a daily basis. I mean, we're living in a world of very low interest rates, so every basis point counts. So this is just a trend that will continue, and I think, as we heard before, the customers do have a significant pricing power these days, and the question value for money will be, will be asked, by a lot of different stakeholders in the universe of asset managers.
As fee pressure intensity, asset managers look to achieve scale. Ilva, how do you see M&A changing the industry by 2025?
Well, I mean, M&A has been going through trends throughout history. In the 1960s, look at that conglomerate mergers, moving into friendly acquisitions, moving into a period of hostile takeovers, and then, of course, now in its private equity buyout, cross-border transactions that have been trending this century. Now, looking into the future, I think we're really looking at transformational businesses. Of course, we've seen increased digitalization, and that's going to continue. But I also see countries possibly looking to protect their borders more, and companies looking to see how can we look after our business in this particular region. And then at the same time, looking into ways of working across border in a way where you don't need to travel, where you don't need to connect with people other than online, like we are here today. But at the same time, being agile and ready for when things change, or where we move into a different way of socializing and doing business that we haven't been doing in the past.
Bill, how do you think managers will focus their M&A aspirations as they seek to compete in this space?
Yeah, I think just picking up on David's point, I think if we look at what has happened over to the sort of investment management space since the GFC, so let's call it 2008, 2009, so the best part of a decade, there's been, post the GFC, what we learned from that is what is value for money. And as the clients experience, what were they actually getting? And I think the consequence of the big structural shock that happened in the GFC and the credit crisis is that there was massive flows into the indexing business, because actually there was a unveiling of the kimono in terms of what was actually true alpha. So what we're actually seeing in the industry is a very large scaled game of indexing, which is stack them high and sell them cheap, and it's an engineering and a production game. And the barbell, which is actually being able to demonstrate you can provide significant value and true alpha rather than just factor risk or leveraged beta. The reason this is important is, especially on the institutional and on the sort of index managers, those big players, because it's a scale game and because it's a big manufacturing game and because fees are getting commoditized, there's a lot of M&A and discussion about how you get more scale in that business. And then the logical next step of that is, in actual fact, that's not going to be enough to provide solutions for clients. So whether it comes to partnerships or M&As, I suspect these big managers are going to have tie-ups with different sources of returns and alpha for their clients.
Now, we've seen several mega deals in recent years, but have those firms really achieved an advantage, Mike?
Coming on the point that Bill mentioned, the scale game of M&A has had a very potted history of success. There have been a number that have been very successful. But ultimately, scale is about, in my view, it's about getting cost economies, and that's about rationalizing your funds, making sure you can create some economics around certain functions, building bigger relationships with distributors so you can do a total solutions delivery. But it's really been somewhat haphazard, the success story of those big mergers that have gone on. But I do see the M&A story continuing because, the industry is going to have to consolidate to get fees down. The point that David mentioned earlier, the industry has been losing profitability consistently over time. The average fee rate in the industry has gone down by a basis point a year over the last 10 years. So I think that scale will continue. I do think a lot of the asset managers will look to acquire elements of their technology that they're missing to buy that in rather than outsource. I do think there'll be an element of buying deeper into the vertical chain, so getting closer to the end distributor, maybe even buying into the platform that distribute to the end consumer. So I see scale M&A activity. I see product gap acquisition work going on for big managers. I see bulking up by boutiques to try to get some scale so they can actually create a sort of a community of boutiques with a single platform. I see vertical acquisitions by asset managers getting closer to end consumer. So, but end of the game, Yevla, you mentioned this, private equity are on the sideline. There's a lot of dry powder. And I think a lot of the private equity firms are looking at financial services and asset management in particular as one place where they could exercise their skills around running businesses leaner, faster, and more innovatively. So I do think the PE dimension could be an interesting one for the next 5 years.
Great. And David, what sort of challenges or opportunities do you see asset managers being exposed to as they seek to ramp up M&A?
Yeah, I think there are multiple ways of looking at it, and I take this, the side that actually, M&A can work. I think there are very clear, aspects to follow. I think first of all, your rationale needs to be very clear why you're doing something. That's number one, and then I think it's all down to the execution. And I think this is whether it's in the asset management industry, but also in other industries. I think it really comes down to the rationale and the execution. And very often you find an okay rationale, but the execution is difficult because that's really the hard part. That's the work that is really necessary. And I think you have to be very rigorous and disciplined in the execution. About systems. Really, making sure you create a landscape and an operating landscape of the future rather than trying to couple, two things together that are not really, working well today. And I'm not really sure that just coupling together will make them great. I mean, in the automotive industry, we have seen similar things where just two engines being put together and, there was a hope that suddenly it's a great thing. Efficiencies need to be extracted. Speed of execution in today's world is really important. And just one point around scale, and I think scale in the asset management industry has moved so dramatically and quickly over the last few years. Even by merging two relatively medium-sized asset managers together, you haven't really reached probably the necessary scale. So I think those are all aspects to consider, and you really have to find your space. Do you want to be in a more niche or boutique way? Do you want to be a regional champion? Do you want to be a global champion? I think all those things need to be taken into account and then really executed extremely diligently, extremely rigorously, and with the necessary speed.
Great, thank you. Now, another big trend that was born out of the awakening that we had last year was out of diversity and inclusion. Ilva, what do you think the asset management workforce of the future will look like, and how do we get there?
Well, financial services, obviously, as a whole, is the most powerful industry globally, but it's one of the most unequal and least diverse industries. That's both a problem and opportunity at the same time, because I think in order to be able to succeed in the future as a business, you have to mirror your customer base, and that is not happening at the moment. So I think the businesses that will survive are the ones who are going to be able to hire the right talent and then keep the right talent, because we often talk about that there is not enough of a pool to recruit from. And whilst that might be on some level true, I don't buy the argument, because we see a big gap in promotion, even in the first round, is about 24% between men and women. And if you then also include women of color, that goes up to over 35%. So we have a problem in retaining the talent within the industry. And I think we fall into this trap quite often, is that we think a little bit in a dinosaur type way, in that we would like to change the people who join us to fit our industry. But I think that's where we go wrong. We need to change to attract the right talent that will help us build the business for the future. And I think that's the only way to go. And we see that the ones who succeed now in other parts of the industry are the ones who manage to do that.
Great point. Mike, what else does the industry need to do to make progress on this front?
Well, I mean, the industry acknowledges that the winners will be the organizations, the asset managers with the best talent. And therefore, the search for talent is getting wider and deeper. The challenges are, one, an over-reliance on metrics rather than a true cultural and principles-based approach where, people are fulfilling tick boxes and certain quotas, which I think, you need to measure, but it should not be the only outcome. I do think there is a big issue of behavioral bias, unknown behavioral bias that goes on, where people tend to recruit in their own like. It's just a human nature. I do applaud asset managers that go beyond the traditional universities for their graduate recruitment, asset managers that move beyond universities as their source of talent and have apprenticeship programs and have very dedicated programs that have to be supported meaningfully and in a time-based manner by leadership. It can't be delegated. So I do think there's a need for the organization to be much more visible at a leadership point of view, getting involved in the initiative of building out a talent base that's much more diverse, much more reflective of society, and definitely one that's been driven both top down and bottom up, because what I've seen from my experience has been the leadership of an asset management firm, the bigger ones, they can have a lot of initiatives around diversity, but it loses momentum and meaning as it gets delegated down through the ranks of leadership, down to the graduates. So I think there needs to be more work done there around incentivizing the total workforce to support a broader diversity initiative. And as Jevla said, when you hire someone, that's fine. The next challenge is, how do you retain them? I think there's a lot of work needs to be done around retaining people through their careers at asset management, because there's a huge amount of turnover in the industry, full stop, and it tends to be biased towards minorities within asset management as to where the higher turnover, because they don't feel welcome, they don't feel there are other people like them around, and then they tend to leave the industry.
I might can I jump in there again? The
Sure.
video, is that okay?
Yes, sure.
I think I just wanted to respond to a couple of those things, and I really appreciate you mentioning the values living throughout the organization. There's quite a lot of strong research that points to, if a leader stands up and says, well, this is our policy, there's a big difference between the leader saying, well, I will no longer tolerate this in my firm, and everybody has to live these values and value. And if you do not live those values, there is punishment coming with that effectively. That works. It doesn't work if you just have policy and do box ticking. And the other thing that doesn't work is to appoint people of minorities, including women, into posts and then not investing in them. Because if you haven't got a role model that you can look up to, which is normally some of the people in this room probably fit that category of role models, then you are going to be less confident about your position once you're there. So if people don't invest in you and develop you in the right way to give you the confidence, then it's harder for you to succeed. Because there is this thing about confidence. If you appear confident, people think you're competent, but that's not necessarily the same thing. So you can be very competent, but if you don't appear confident, you will not survive in the industry. And then I wanted to make one other last point, because you talked about decision making, and I think that's an important area, because the homogeneity in the decision making is damaging the industry. It's overconfident risk taking that is the problem. And the more collaborative approach that you get from a diverse team will make sure that more voices are heard around the table, and that you take more situations or analysis into account before making decisions, and that will reduce your overall risk. Because we all know that model portfolio theory teaches us that you should invest in a diverse range of assets. That's how you create an optimized portfolio that produces the highest return for the lowest level of risk possible. But we don't model that in our organizations. The proper intersectionality is what produces the best return for businesses.
Great. And speaking of investing in the workforce, Bill, are we doing enough to invest in developing a pipeline of diverse talent?
Yeah, so I think the original question was, what is the workforce going to look like? And I think I think we all accept the fact that maybe the position or the journey this industry has been on has probably been unsuccessful to this point. But I think the future is very bright. And I think part of the problem is, picking up on a couple of the points the panelists have made, is that you ask the financial sector to solve a problem, and then they tell this financial sector, you're going to be calibrated by a set of data and metrics. The financial industry is going to solve that really, really quickly, but they may well solve it in the wrong way. And you may end up having perverse outcomes, which is actually the wrong people fitting the right sort of tick boxes. What you really need to look at is culture and values. And I think that ultimately, and the reason I'm positive about this, because I do think we're in an inflection point, and COVID is going to be part of this as well. But I think if you look at the next gen, or the next cohort of graduates or employees, they want a employer that looks and feels like the rest of the employers that they may have an opportunity with as they leave school or university. So they want a contemporary organization and a progressive organization. So you're not going to be able to keep talent unless you are offering an organization that has the right cultures and values. The other thing is that quite clearly clients want to invest in companies or into funds that look and feel like what they aspire to in their own values, in their own worlds. So I think we are at an inflection point. I do think the industry has been going down the wrong path, but I think we're at an inflection point where it's pretty positive going forward.
And we've spoke about holding people accountable for diversity and inclusion and for values. How is Quintet, as an asset owner, hold their strategic partners accountable for those for D&I?
Yeah, so it's exactly sort of the point I was making earlier, is as firms need to evolve their sort of DNA, culture and values, as we then take our clients' assets and we look in as a fiduciary to go and invest those assets, we've got to ensure that those asset managers or those investment managers look and feel and are doing what we believe are our core values and what we're representing on behalf of our clients' assets and money. So we talk about, it's not just about investing in ESG funds, because that's a product, and that to some extent is going to just be a hygiene factor in terms of investing money. It's actually understanding the company's CSR programs and what does a company actually stand for within their own corporate and sustainable and responsibility frameworks. So we dive straight into that when we're talking to partners and strategic partners to make sure we're comfortable as a fiduciary how our clients' assets are going to be invested.
And Mike, how are you seeing institutional investors approach D&I with their external partners?
Well, for starters, they are putting it at the front. There's always been this belief that when asset owners come to an asset management company, it's people, process, performance. The fact is, there's a kind of, I would say, a first step, which is culture. And if you look at the financial crisis, a lot of it was a failure of culture. Where people literally didn't do the right thing, didn't know what the organization they work for, what the right thing was. So I think what we're finding now is the asset owners are putting the culture of organizations at the front of the due diligence to understand what are the principles by which that organization is run, to what extent is the leadership talking those principles, how are they being supported and re-ingrained in the broad population of the organization. But it's becoming sort of the anchor that a lot of the asset owners and consultants are looking at the first point of reference as to whether they want to do business with an organization.
Great. And David, are you seeing financial advisors asking a lot of questions about asset managers' D&I efforts?
Yeah, I think I mean it's it's a topic whether you're an institutional asset owner, whether you're a financial advisor. I think it's front of mind of everybody these days. And I would like to, I think many things have already been said by the colleagues here on the panel. I would like to take one point, which I think is, for me personally, is very important as well. I think investing not only starts when the people are actually already kind of like either interviewing or in an organization. I think we have to do a lot more as an industry around education. And education starts, when kids are in school. We have to, help them to either, confidence is one, but also, making sure that, it's they have the necessary. They have a lot of education. I think and also financial education. I think there is probably a lot of myth out there about what we're doing in the asset management industry or just generally financial service industry. And we have to break that. We have to make it accessible, and we have to invest as an industry a lot more into education of people, and especially younger kids.
Thank you.
I think that's absolutely right. Sorry, I'm jumping in there again, if that's okay.
Go right ahead.
I think I think that's a really important point you're making there, David, about education starting young, because you start seeing the gap in self-perceived knowledge and confidence starting at secondary school age. So the sooner you can start to get into the minds of young men and women, or people regardless of what gender they identify with, the better, to make it feel accessible to everybody, regardless of who they are. I think that's important. And I think another thing that I'd like to add is that in a research, I have lots of studies in this topic area, obviously, but in one of my studies, I find that female brokers are more efficient in the trades that they sell and the fees that they generate. You have this theory about men trading too much, too often, and are overconfident in their trading. And I see that pattern in my research. And so I would call to the industry to do more about looking at the P&L that their staff bring to justify and to inform gender pay gap and promotion, rather than sort of sticking to traditional norms.
Dervedia, just to dive in here as well, and I was just picking up on a couple of David's points on academia and better relationships with schools and stuff. I think one of the areas that especially large, well, let's call it the industry rather than just picking on large financial services companies. I actually don't think they do enough within their own communities. So if you look at some of the big financial hubs, they're not very far away from some of the more deprived boroughs or some of the struggling secondary schools. And I think that there is a onus, and it helps diversity. And I mean diversity of thought and diversity of background as much as the other metrics of diversity. And I'd like to see the industry sort of spread the wealth, if you like, in terms of the intellectual wealth and the opportunities that they come in some of these financial hubs across the communities that they sit in as well.
Great.
I think, Bill, the one I call out there's an apprenticeship program now in London. And a number of the asset managers have supported that. And that's been a phenomenal success, because what it does is, one, it is focused on more of the private parts of London, but it brings in the kids that are not going to university. And then it sponsors them, a lot of them through university, but rather than wait to pick them up if they leave some of the red bricks, they're actually trying to get them at secondary school, from schools that don't have a history of putting those kids into finance, and trying to basically support them. So that addresses a few things. One, the education issue around financial literacy and savings. And two, it broadens a diverse pool from which asset management and financial services can then recruit. But those are the exceptions still, rather than the rule. And I think that says, but they are successful, so it shows it can be done.
Agreed.
Great. And now, one of the forces that might actually help D&I efforts is the COVID-19 pandemic, given the flexibility that employees have been afforded. Mike, do you think that a flexibility and work from home can help with not just recruiting a diverse pipeline, but also retaining underrepresented groups?
Oh, 100%. Flexibility is, if you look at, I mean, I've got two teenagers. I mean, the flexibility is the kind of the expectation of their lifestyle. They're respected, but they need the flexibility. So I do think that having a flexible workforce is going to work in favor of industry, not just financial services. I do think what we've just been through, there are some big lessons for the industry. One is you can be productive and efficient without being in the office. Uh, Two, you can trust people to manage their time remotely. The third one is technology. Is a lot more resilient than people would have estimated a year ago. I don't think anybody would have expected you can run 1,000, 2,000, 20,000, 30,000 people remotely from the office successfully on technology. So I think that kind of reinforces the reliance on technology spend to support the industry model going forward. And the third one is, do you need to have everybody in the office? Do you need to have everybody flying around? You can actually run a more efficient and a more profitable business, yet be more productive, more client friendly, and reduce costs in the same breath. So I do think the industry, on the talent side, on the cost base side, there's a lot of lessons learned from what we've been through over the last 12 months.
Ilva, do you think the trend of accommodating more flexibility is something that will sustain after the pandemic?
I hope so.
I think so. I think so. You know what? I've come from an organization prior to joining Carne, but I will tell you, the worry is how do you build a culture and how do you that basically everybody understands when they're sort of working remotely, when you're onboarding, because again, if you think of it, the industry turns over 10% a year. You're recruiting young people into an industry. How do you basically get them onboarded safely, building a community, which, as a community, we've all grown up very much with physical interactions rather than remote. So there's new learnings required. But the challenge will be, how do you bring new people into your organization? And more importantly, how do you bring young graduates and young recruits into your organization? Get them into the community, the culture of the organization. Doing that remotely, I think that's the one area I would still have some concerns as to how we do that effectively and safely.
And in terms of maintaining this going forward, as and when we can finally go back to socializing with each other again, then there is always the problem of reverting to type. And that is what the industry has suffered with that before. For example, after the credit crisis, when we all knew was overconfident risk taking, like you said earlier, Mike, I think it was you about culture. But we quickly reverted back to the old style culture and the old style leadership methods. There hasn't been that much change. And of course, the stigmatization about working from home has been removed now largely to those who were underperforming and couldn't possibly make it into the office, to actually everybody's doing it. But to see the changes going forward now, how sustainable they are, I think it'd be very interesting. And it is now demanded of everyone that we can be more flexible, and then we're being heard. When it was demanded of the people who could produce but needed to work from home, it wasn't heard. So I still think that we need to be able to open our ears to hear minorities, to hear people who don't fit the normal mold. Because when the ones who fit the normal mold want to change, then we can change. But we still struggle to hear the outsiders, I think.
Bill, what do you think? Are we open to that change, or will we sort of revert back as soon as the offices open up?
Well, I would be very surprised if we revert back. I think that COVID, if there's one good thing that comes out of COVID, is this and a couple of the discussions we had earlier about diversity. I think this torpedoes the orthodox, the inertia of working practices. This has just been one very large, real business continuity exercise and disaster recovery that has just shown everyone from employers to regulators that actually you can do this, and you can do this as effectively you want remotely. We have the technology and we have the skill sets. However, I think there is going to be a normalization which doesn't feel like how it was before, but isn't what it is today in terms of 100% remote, because I think there are certain parts of this working from home and the situation we're in that actually undermines some of the sort of basic principles of human interaction, which is all about creativity, sort of thought leadership, engagement. I talk about conflict resolution is very difficult to be done remotely as well. And I think there is a path back that doesn't look like the previous norm. And as I reach out to my teams, I'm telling the teams, look, why don't you start mapping out and creating what you think working practices should look like going forward? Well, rather than having your employer then saying, oh, you're back 100% of the time, I'm asking my teams to think about, well, how does a new working model look? We've proved the fact we've got operational resiliency and we can do this, and we are producing the right outcomes for our clients. So let's produce the right outcomes for the employees. And they are going to be designing themselves what the working practice they want to take forward. And then that will engage the next generation of employees. And that will help the sort of work-life balances and ensure we have all the retention questions we had earlier on in the panel, hopefully to a large degree will be solved as well. So I'm very positive. If there's one good thing that's come out of this, is that I think how we work will be different and better.
If you have a large part of the workforce working remotely, David, how do you think firms can build community and build dynamism and teamwork when some people are at home?
Yeah, I think we're still learning a lot about the new situation. I think we probably have to take a step forward and also be willing to take a step back from time to time, just to, test a little bit what works and what doesn't work. I think, onboarding was mentioned. I think, I know a lot of younger colleagues that are onboarding totally virtually, and, sometimes they struggle because, they're still, learning about the firm, learning about the culture, but also, trying to make connections throughout the organization. So sometimes this, it works, but I think the normalization was mentioned. I think it will happen over time. People want to meet again physically. I think, within a company, but also with clients. I think that's the other aspect. I think how do you work with clients, existing clients, but also, new clients. And I think it needs a lot of communication. And, again, it will evolve over time, and probably the way we communicated in the past is not the way we're going to communicate in the future. But I think we have to be willing to just be very open and think differently. I know it sounds a lot easier. It will need a lot of leadership from, the top of organizations to be willing to, change and rethink and then lead that change. And, for me, one topic is that I have seen many times before, alpha generation is in a way not location dependent. We usually have kind of like the big centers where alpha is perceived to be generated, but I think we have to be also open to think about that alpha can be generated anywhere. It's not dependent on a location these days, I think, because information is available, information is transparent. And so I think we have to be willing to learn a lot and be open to learn, whether as organizations, but also as leaders, but also as, individuals. So it will be different.
And so we have an audience question on the topic. What are your views on entering the industry later in your career, unlike graduate or school leaver levels? And what are the key success factors to doing so? Anyone want to take a shot at that?
I let me touch on that. I do know one of the programs in one of my previous lives was a re-entry program, and it was a mid-career re-entry. And it comes back to the point Yevla made, is that you can't have it as something which is the firm endorses. You've got to have leadership and people who are actually tasked with making it happen. So it's difficult to enter the industry later in career. Even with re-entry, what it does need, it needs safe entry points with an environment that's supportive of that person re-entering, because the skills you have when you left the industry may not be the sort of point at which you re-enter. So I do think it does require senior leadership commitment, senior leadership time and effort, and not just being delegated down the ranks to somebody who supports it as a sort of a HR function. But I do think it's difficult unless there is a purpose and a positive engagement model in the organization supported by leadership to make it happen.
I
Wait,
think,
and I want to pivot.
can I jump in on that one as well? Is that okay?
Yes.
I'm on my fourth career, essentially. I transitioned into academia after a long time in banking, being a fintech entrepreneur, psychotherapy. And I would really encourage whoever asks that question to go for it. Transferable skills are tremendously undervalued, and the industry needs people who think differently. So if you come with a different background, with different experiences, I'm sure that with the right attitudes, like Mike just mentioned, you'll be welcomed because you will contribute something. You might not even be able to imagine what you might contribute, but speak to a few friendlies in the industry, try to gauge from them what the industry really needs, and then sell those skills.
Great. And I want to jump into another hot area, social media. What role do you think social media is going to have, or how are we going to change the way we look at it by 2025? Bill?
It's a bit of a timely question and topic, given what's happened over the last 10 days or so. So social media, as it sort of collides with the financial industry, is incredibly empowering, and sort of the democratization of the process of investors, I think, is really, really important. But as I look at some of the events over the last couple of weeks on social media platforms, I think there's a lot the industry needs to do to protect investors. It's interesting, over the last 10 years, post the credit crisis, there's been a lot of evolution of regulation and behavior in which financial organizations are driving investor protection to the heart of everything they do. And that is right. But actually what we've seen with the emergence of apps and trading and social media, there's a lot of information that goes around, and there's a lot of herding in that information, and that can be quite dangerous. And a lot of what has happened over the last couple of weeks is pretty close to collusion, whether it's advertent or inadvertent. But what does happen is that there will be innocent investors that will end up losing quite a lot of money through the sort of herding and that sort of social media dissemination of information. So I think it's very empowering, and it is part of the future, but we need to be careful that we protect those less sophisticated investors as they start putting their savings into the markets via just social media. So I'd always say there's a reason why there's professional advice out there. And I'd always say that, if you're not sure, do your research and get good advice, because definitely with the moves we've been seeing, there are going to be retail investors, innocent investors that are taking significant losses. And that's not great. And it's not a great anecdote for the industry either.
And Mike, you have a slightly different view.
Yeah, I'm part of the baby boomers. And if you look at where we are today, baby boomers and the generation ahead of us, that's about 25, 30% of the world population, 25% of the world population. By year 2030 or year 2025, it's going to be less than 10% of the world's population. So 90% of the world's population, millennials and all the younger, this is their mode of communication. This is their mode of interaction. So I think our industry is just going to have to move to them. The regulation issue will get resolved, and I know it's something which is, as Bill said, it's not been resolved yet, and we've seen that through a bunch of recent developments. But I think, if you think of it, 90% of the world's population, and by the way, you go to Asia, you go to China and Taiwan, almost all of the retail investment management is done via social apps. So I think, it's a question really of asset managers, appreciating that. You need to think about your marketing and your branding because, again, the news travels fast, good and bad. There is the issue about which you distribute products. We have a very traditional mindset in asset management. I think the platforms themselves in Europe have become very digitalized. I think the communication to the end investor is becoming very digitalized, and the old media we've used is gone. So I think, from the perspective of the end consumer, we'll be predominantly communicating with us and us with them through social media. Bill's point, I do think the markets are going to have a new influence in it, whether it's an alpha source or a risk source. It's going to be there, and I don't think that's going to go away. I think the regulations are still developing, so we don't know where this is going to land. But I do think that it's going to be a major challenge for our industry because our end consumers, $30 trillion of assets are going to be inherited from the baby boomers to the next generations over the next 15, 20 years. So they're going to have the assets, so as well as their preferred way of communicating, and the industry is just going to have to move towards what they want.
And Ilva, how do you see social media shaping the industry or being shaped by the
Well,
industry?
Well, social media is here to stay. So this is another example of we're even seeing everybody from all parts of society going to social media to try to run countries and make decisions that can have devastating effects. But the industry is what has to change. It's not going. I teach on MSc. I teach asset pricing and banking and finance at King's College, and I teach on social media. So my students are learning the trade effectively in social media. All their interviews are online. That is what we are learning, and that is indeed the generation to come. And that's how we learn to communicate. Our children communicate with their friends, use on social media all the time, more than they spend time physically together, even when they could prior to the pandemic. So we have to get out of our comfortable position and innovate.
Great. And we have one more audience question. Why wouldn't we see tech providers who are moving into payments and wallet provision already not move into asset management product delivery via acquisitions, creating a true online fund supermarket access point for consumers? Anyone want to jump in on that?
I'm happy to dive in at a high level. I mean, I think this is happening anyway. I think sort of segueing on from the social media, everything has a technology edge. If you're going to be competitive in this industry, you need to be competitive in technology, whether it's your AI platforms or it's your social media delivery. So the big finance houses are in it already. They are trying to create the best algorithmic deliveries of processes. Whether the big tech giants are going to step in, well, I think they could, but the question is the right margin product to add to what they're doing, given the fact that we've just discussed at length how margins and fee pressures are compressing on a day-to-day, month-to-month basis. So, but I do think that a large part of the financial services is actually going to be a tech industry.
Actually, on that point,
Great.
Bill, my experience has been, and when you talk to some of the big tech firms, what they are aware of now is the cost of acquiring and maintaining a client in a regulated financial space, the KYC, the AML. It is, and it's getting more complicated. And for them, they've got other areas they can follow for a higher margin business. And in the industry, asset management, one of the price pressures that the margin issues is the regulatory cost, and that's going up. So you look at the big tech companies and they ask, do I want to get into a highly regulated environment where the margins are coming down, where there's a cost of maintaining sort of financial records and KYC, AML, or would I actually look to actually grow my business somewhere else where I can make more money?
Yeah, absolutely.
Great. And I believe we have time for a quick one-word lightning round. What's the next innovation on the horizon? David?
I'm probably not the best to talk about innovation, but I truly believe that we have to invest in education and the talent that actually will develop the next level of innovation. That's my belief.
All right, we've actually just about run out of time, so I have to thank you all for listening, and thank you to the panel and our sponsors, FE FundInfo and Carne Group. Next up, we have Luke Frieden and panelists in the final session, Brexit and the U.S. elections, which starts in 10 minutes. Thank you.
Thank you.
Thank you.
Thank you.
Thank you.